This is the May 20th property data report. And if you're not paying attention, you're going to miss the market shift everyone else will pretend they saw coming. Right now, rents are softening, clearance rates are dipping, listings are drying up, and yet house prices are through the goddamn roof. If you're an investor or a first home buyer trying to read the tea leaves, this update is your crystal ball. And no guys, this isn't clickbait. This is your money. Today, this is what we're unpacking. Firstly, what's happening in each capital city, state by state, suburb by suburb. What auction clearance rates are really telling us at the moment? Why are asking prices the leading indicator most investors still ignore? And how to interpret vendor discounting, days on market, and buyer demand. That's right, guys, the juicy stuff. And why smart investors aren't panicking at the moment, like my clients? Because they're too busy planning with me in terms of holistic lending to get ahead above people, the average players like yourself. But don't worry, guys, I'm not leaving you guys out who are watching this channel and supporting this channel. Let's break this big picture down. So right now, guys, let's take a snapshot of the national property market. So right now, guys, Australia's property market is like a walking tightrope. Inflation is cooling, meaning we're likely to see rate cuts again, just like the one in May that happened last week. Because we never know, guys, there's another RBA meeting in July the 7th or the 8th, or somewhere in July, Tuesday. And you know what, guys? There might be another potential rate slice. And right now, guys, unemployment is low. This means people still have jobs and spending power. And I know what you guys are asking at the moment. What about consumer confidence? What about my confidence? What about other people's confidence? Well, at the moment, it's still kind of flaky. More like volatile. Sort of like fragile, like a two-bedroom reno in Western Sydney, if you get what I'm talking about. But yet, guys, prices are still creeping up anyway. According to CoreLogic, national dwelling values are up by 0.3% in the last month. And that's a 2.4% increase compared to the last 12 months ago. So while the media headlines are screaming, oh, affordability crisis, the numbers are quietly saying the market's not crashing, guys. Shut up, you doomsayers and naysayers. The market is not crashing. And in my humble opinion, I think it's just fragmenting, correcting itself. So right now, guys, let's go city by city. Let's zoom in a bit so that you guys can get a bit of data, because this channel is all about data and not speculation. Because as you guys know, as I preach on this channel all the time, not all growth is created equal, which means every city is different. In terms of city by city breakdown at the moment, guys, in terms of data, let's go top down. And we have Sydney first. Sydney prices this week, well, it's kind of flat, up by 0.1% for the month and up by 0.6% year on year. And I know what you're saying, Q. Put that in English. What that really means is the market's moving like Sydney's trains. It's barely moving at all, but still somehow more expensive every goddamn month. Now moving to Melbourne, their property market in terms of value moved by 0.1% weekly, and they are up by 0.2% monthly. But in terms of year on year compared to Sydney, they're down by minus 1.9%. In my opinion, guys, Melbourne is still the underachiever of the class. What I think, guys, is they're still struggling to bounce back from post-lockdowns, but maybe, guys, just maybe, the investors are circling back again. Now, in terms of Brisbane, they're up by 0.3% for the week, and they're up by 0.6% for the month. Despite the floods, despite Cyclone Alfred, in terms of annually, they're up by 7.4% annually. In my opinion, guys, Brisbane is the golden child right now. If you bought 12 months ago, well, congrats to you, buddy. You're up. And if you didn't somehow buy in Brisbane, well, you're late to the party, guys. But don't despair yet. The music is still playing. And in terms of Perth and Adelaide, guys, houses are up by 14.2% year on year. And in terms of units, up by 26.5%, guys. This is based on CoreLogic RP data. Like, this is not me making this up. This is based on CoreLogic RP data that you can Google right now and read for yourself. And for Adelaide houses, guys, it's up by 11.6%. And for units, it's 16.5%. Like, I don't know whether you guys realize this. This is not a property market anymore in terms of Australia today. That's like a rocket launch, guys. Like, these cities at the moment, guys, they're no longer secondary markets. They are the core growth zones, just without the bloody traffic jam that we experience in Sydney. So right now, guys, if you're still paying attention, let's zoom into a signal even sharper than sales prices. We're talking about asking prices. Now, right now, asking prices are the future in disguise. Because right now, guys, you're watching this, if you want to know where prices are headed at the moment, the best way is to ask the sellers. Like literally. Here's what the latest SQM research data says. Sydney median asking house prices at the moment are at $2.3 million. And that's technically down by minus 3.07% according to SQM this week. And unit prices are average $854,000 asking price. And on the opposite effect, that's up by 0.5%. And what do you make out of this data, Q, you might ask? Well, right now, there's a pullback in seller confidence for freestanding homes. And this could be an opportunity for you investors out there, to snap a bargain. And in terms of Melbourne house prices at the moment, the average asking price is $1.27 million. According to SQM, that's actually up by 0.79% this week compared to last year. In terms of units, their average asking price is $628,000. Again, that's up by plus 1.03% according to SQM. What I make out of this, guys, this is a steady climb. Investors right now are clearly eyeing the unit market again. And based on my previous video, this is all based on cheaper entry prices. Right now, they're yielding better yields. Now, obviously, due to a large exodus of investors leaving the Melbourne market due to higher taxes. And again, guys, I think that's an overreaction, because right now, investors are actually flooding back in to capture the gap in the exodus of large investors, where right now there's a demand in rent from people in Victoria due to a large proportion of landlords leaving Victoria, and a lot of people have nowhere to rent because all the property are occupied by owner-occupiers. Now, isn't that wild and ironic? Now, moving on to Brisbane houses. They're up by 3.2% at the moment, just this week. And for units, they're down by 0.7%. So as you can see, guys, state by state, city by city, all operate at different paces in the property market. Because right now, guys, buyers are chasing space. And at this moment, guys, yields and growth both favor houses right now in Queensland. So by reading these asking prices, they tell us where sellers think the market is headed. And at the moment, if you're reading that data, especially the price increases in houses or units, you gotta think to yourself, if these sellers are hiking their prices this confidently, we investors need to pay attention. Something's going on in these cities. But guys, I'm not done yet. Don't click off, because prices don't just tell the full story. Right now, let's talk about auction volumes and clearance rates. Right now for auctions, what I've noticed is that I see the desperate and the rich collide. As of May this month, 1,835 auctions were held last week across the capital cities. Clearance rates were at 68.8%, and this is down from the last year's 70% recorded recently. Melbourne at the moment led by 73.8%, and that is the highest clearance rate of the year. Sydney at the moment fell by 65.3%. That's the lowest since December 2024. Food for thought, guys. And for Brisbane, it slipped by 59.6%. Now, that's a very interesting data. It kind of feels like investors are hesitant in that market. But overall, guys, this is still a seller's market, but it's showing signs of fatigue. Because right now, what I think, buyers are still waiting for the RBA to cut again. And for now, guys, for those that are waiting, they're not just waiting, they're actually renting at the moment. Those guys who haven't bought, they're renting. So right now, guys, let's look at how rents are behaving. In this segment of the video, we're going to look at rents, yields, and in between that, the real pain points. At the moment, the National Rental Index rose by 0.6%, and this is for 3 months straight, guys. But here's the twist. Year-on-year rent growth is down from 8.3% to 3.6%. What this really means is the heat is cooling, guys. The average Sydney house's rent, at the moment, it's $1,065 per week. And as per this week and the last 3 months, it barely moved. It stayed the same. For Melbourne units, it's minus 0.6% this month. Brisbane houses, they're still up by 5.7% year on year, but signs are showing that it's slowing down. So from all that data I've just mentioned, it might sound like rubbish to you, like what does that even mean? This is my takeaway. In summary, guys, rents are plateauing, yields are stabilizing, but repayments are still crushing your soul. Like at the moment, as a mortgage broker for the last 15 years, I've seen rates coming from 1% to 2%, then 15% and down to 5%. Right now, the average investment rate is 6.5%. And at the moment, that's kind of crushing a lot of investors' soul. So right now, let's move from renters to actual sellers. In my opinion, I think sellers of good properties, those that are selling properties at the moment, they're gone. And I know what you're thinking, you're scratching your head thinking, Q, what are you saying? What I'm saying, guys, is for new listings, according to the data above, they're down by 12% below the 5-year average. A lot of sellers do not want to sell their property at the moment. Some of them are waiting for capital growth. And in regional areas, they're down by 16.7% according to the data. Now, right now, guys, that's not just seasonality. What I think that is fear. I smell fear, guys. There's a lot of hesitation in the selling market at the moment. And this is what I think. This is people thinking, all I want to do right now is wait for the RBA to have another July rate cut. And then with more fuel added to the borrowing power in terms of the banks, people will feel the FOMO. And then at that moment, I'm going to jack up my property prices and then cash out. Which means at the moment, guys, in this month, according to that mentality, supply will still stay tight. And with the government not building enough houses, combined with this mentality, we will never ever achieve affordable housing. And this is where I'll segue to who is to blame. Who do you think I'm going to roast right now? Well, the people to roast is the government. Right now, they're still pretending 1.5 million migrants who are entering this country, plus 50,000 new builds every year equals a balanced market. They're on cray-cray drugs. And for developers, guys, I'm going to roast them too. A lot of these guys are sitting on DA approvals, but not building. And I get it, guys. Their margins are too thin. The cost of construction is too high at the moment. And in terms of buyers agents, yeah, I'm roasting you guys too. You guys are still flogging off-market townhouses in flooded zones. And for investors, including myself and all my other clients, we are also to blame as well. A lot of us are still holding off and waiting for a crash. You guys are thinking, okay, our economy is in a stagnation, and the next point is when the market crashes, prices dip, and I'll swoop in to cash in on a bargain. Now, right now, your thinking is not crazy, but let me tell you guys, somewhere in your thinking is wrong. There's not going to be another crash. So if you're watching so far, you're thinking, Q, all this information, all this data, what do you make out of all of this? Well, this is my personal humble opinion, not financial advice. Here's the truth, guys. The housing market at the moment isn't crashing. It's just fragmenting. And I say this time and time again, the economy isn't broken. It's just shifting. And for real estate guys, the things that make my bread and butter, because I'm a broker, I think at the moment it's just becoming a gain of position. So right now, you got 3 options that you can do right now. And I harp about this all the time. Number 1, you do nothing. You wait and you hope. Number 2, you panic. You buy anything with a rental yield. You just like buy it for the sake of bloody buying it. Like a lot of clients that are doing at the moment, like, oh, FOMO, I'll just buy something. Or right now, you can play smarter. You can use data that I've shown you in this video and the other videos I've been uploading. You can read sentiment like those asking prices from SQM. And I want you to focus on areas with high income buyers and low future supply. So right now, you want help cutting through the noise. What I suggest is book a 50-minute strategy call or a 60-minute deep dive with me where I can introduce you with my holistic lending solutions. I can recommend you financial advisors, accountants, respectable buyers agents that have good track records to find the right property for you in terms of your tailored strategy that you discuss with us. If you're not ready yet, just smash the subscribe button, hit the like button if you like this video, and hit the bell notification for future videos like this. And overall, I love to hear your comments. Jump in the comments below. Tell me what you think. How is your city doing? Should we invest in your city as investors? And until next time, guys, I'll see you on the other winning side. And thank you for watching another episode of That Property Roast. And I'll see you in the next few days.